Okay. All right, folks. So in the last class on Monday, we started talking about our final topic on the term structure of interest rates. Just a quick review. What is the term structure? This is the comparison among bonds of different maturities that have otherwise equal characteristics, things like liquidity, default risk, tax characteristics, etc. The question that we want to try to answer is what is the relationship between the interest rate and the maturity on those bonds? Okay. We are analyzing that question by taking a look at the yield curve, the Treasury yield curve in particular, right? You guys remember what the yield curve is? This is a graph that shows a snapshot of the economy at one point in time, which shows how the interest rate on bonds depends on the maturity of that particular bond, right? So you have some bonds that have a really short term to maturity, like 1 month or 3 months, all the way out to a very long term to maturity, as much as 30 years, all right? All right, so in trying to develop a theory of the term structure, the first model that we talked about was this thing called the pure expectations theory of the term structure, all right? Now, hopefully you guys remember essentially what that model predicts. It says that the interest rate on a longer term bond, like a 10-year bond, for example, should be the average of the interest rate on short-term bonds currently, as well as expected over the lifetime of the long-term bond. And we derived that term structure equation in the last class that shows this theoretical relationship between current and future short-term interest rate and long-term interest rates, current long-term interest rates. All right, and then we did a couple of exercises together. Let me just kind of ask you, I guess, a review question that centers around this idea of trying to interpret what the yield curve is saying. Okay, so here's an example of a yield curve. It shows that the interest rate on a 1-year bond, that is 1 year to maturity, is 2%. The current interest rate on a bond that matures in 2 years is 3%. And the interest rate on a bond that matures in 3 years is 4%. In other words, the yield curve here is upward sloping. All right. What does that imply then about what investors think short-term interest rates are going to be in the future? If the current 2-year interest rate is 3%, then according to the expectations theory of the term structure, what must the 1-year interest rate expected to be next year? It's expected to be higher. In fact, it's expected to be 4%, right? Because 3 is the average of the 1-year rate today, which is 2, and next year's expected 1-year rate, which would be 4, right? The fact that the yield curve shows us that the interest rate on a 3-year bond today is 4%, what does that tell us then about the interest rate expected on a 1-year bond 2 years from now? It is still going to be higher. In fact, it's going to be 6%, because the average of the 2% and next year's 1-year rate of 4%, and then the 1-year rate 2 years from now of 6% gives you an average of 4% on the 3-year rate today. So the expectations theory of the term structure says that an upward sloping yield curve indicates that investors or financial market participants think short-term interest rates are going to be rising in the future. That's how we interpret that. What about a flat yield curve? So what if I showed you a picture of a yield curve where the 1, 2, and 3-year bond rates were all exactly equal to 2%? What does that tell us then about investors' expectations about 1-year interest rates in the future? Levi? They expect them to be 2%. So again, viewing the yield curve or the data through the lens of the expectations theory of the term structure suggests that a flat yield curve means that investors must think interest rates are going to remain, short-term interest rates are going to remain constant over the next couple of years. Very good. What about an inverted yield curve? So here we have a yield curve that says that the 1-year rate today is 6%. The 2-year rate today is 5%. So what must investors think the 1-year rate is going to be next year, Brian? Lower, and in fact, we know by exactly how much. 5% today is the average of 6% and 4%, right? So investors must think that the 1-year rate is going to be 4% next year. The fact that the 3-year rate today is even lower, 4%, means that investors must think that the 1-year rate is going to be lower still 2 years from now. 4% is the average of 6%, 4%, and what, 2%? So a 3-year interest rate of 4% tells us that the interest rate on 1-year bonds 2 years from now is actually going to be 2%. So that future short-term interest rates are going to be considerably lower. You see how we interpret the slope of the yield curve? It gives us a peek or a glimpse at what investors think is going to happen to short-term interest rates in the future, right? That's a particular skill that you need to have. All right, I'm sure I'll test you on that, is being able to interpret what the slope of the yield curve is telling us. Now, I'm just going to warn you, before we're done with class today, we're going to modify this interpretation a little bit by looking at the liquidity premium theory. All right, but I'll explain all of that in due course here. Okay, so what I want to do now is, I think that you guys have kind of mastered this understanding of the expectations theory of the term structure. I want to spend some time talking about one particular way in which this theory doesn't really work very well. But before I do that, let me just point out the 2 ways I think in which the expectations theory does succeed. All right. First off, the expectations theory, I do think, provides a really logical explanation for why the yield curve may be upward sloping, flat, or inverted. In other words, it provides a logically consistent theory of interest rates that matches what we understand about how investors actually behave in the real world. What it tells us is that an upward sloping yield curve means investors must think interest rates are going to rise. An inverted yield curve means they think interest rates must fall in the future. All right, that's one of the successes of the expectations theory. It matches our understanding of the way bond investors are actually viewing the world. Another success of the expectation theory is, I think it does a good job of explaining why short and long-term interest rates tend to go up or down together over time. That is, they have positive co-movement. Remember that graph I showed you guys in the last class of the 10-year Treasury rate versus the 2-year Treasury rate, and how they both tended to rise during the 70s and then fall during the 80s, 90s, and 2000s? Think about it. This model of the term structure does a pretty good job of explaining that feature. Why is that? Well, it turns out that movements in short-term interest rates are usually pretty persistent in the US economy, meaning that if short rates start to rise, they tend to be high for an extended period of time, or above average for an extended period of time. All right? If that's true, then what should happen to long-term bond rates if short-term interest rates are high and expected to be high for several more periods? Well, the term structure tells us that the long-term interest rates are the average of current and expected future short rates. So if future short rates are expected to be higher than average for a long time, then that means the current long-term rates should also rise. You guys can just look at the term structure formula, right? If the short-term interest rate goes up, that should put upward pressure on the long-term interest rate. They're positively related to one another. And so we would expect then interest rates of different maturities to co-move together over time. The expectations theory, I think, does a pretty good job of explaining that. What does it not do a very good job of? This is the weakness of the expectations theory. I think it does a poor job of explaining why the yield curve is usually upward sloping. Again, go back to that figure from the last class that shows the 10-year Treasury rate and the 2-year Treasury rate. Most of the time, the yield spread is positive. That is, the yield curve is upward sloping. Sometimes the yield spread was negative, which means that the yield curve would invert. But by far, most of the time, the yield curve is upward sloping, okay? Now, let's try to rationalize that from the perspective of our expectations theory of the term structure. What is it saying? What does an upward sloping yield curve mean? Investors must be thinking that interest rates are going to rise in the future, right? Well, if the yield curve has historically usually been upward sloping, then what that implies is that investors must think that interest rates are going to rise a lot more often than they think they're going to fall. Well, we know from interest rate data that interest rates go up with about the same probability as they go down over time, okay? So in practice, these short-term rates are just as likely to fall as they are to rise. What this suggests then is that the expectations theory of the term structure is neglecting some aspect of the bond market and interest rate behavior that will help us understand why the yield curve is upward sloping most of the time. The pure expectations theory of the term structure doesn't explain that because it would imply that investors are always thinking interest rates are going to rise. That can't be plausible, right? There's no reason why an investor would think that interest rates are going to rise 98% of the time, but only fall 2% of the time. It doesn't really make any sense. So what we would like to do now is think about how we might modify or add on to the expectations theory of the term structure to help kind of rectify this failure to explain why the yield curve is usually upward sloping. That brings us to our second model of the term structure called the liquidity premium theory. Now, here's what I'll tell you. The central failure of the expectation theory of the term structure to explain why the yield curve is usually upward sloping stems from one of its assumptions. This is always true about economic models, macroeconomic models in particular. Its failure to explain some feature of the data is going to be directly tied to one of the assumptions that is embedded in the model, that the model is built on, okay? Do you guys remember what is the critical assumption that the expectations theory hinges on, Brian? Exactly. Investors are indifferent between short and long-term bonds, meaning that short-term bonds and long-term bonds are viewed as perfect substitutes for one another, okay? The liquidity premium theory holds that investors view bonds of different maturities as substitutes, but just not perfect substitutes, okay? In other words, what the liquidity premium theory does is it relaxes this really strict assumption about investors being indifferent between the buy and hold strategy and the rollover strategy. That is holding a longer term bond or a sequence of shorter term bonds, okay? Specifically, what the liquidity premium theory says is that investors actually prefer to hold a sequence of short-term bonds rather than a long-term bond until maturity. Now, why is that? Well, in practice, longer-term bonds are subject to greater interest rate risk than short-term bonds. Now, I'll define what that is in a moment because that's a very, very important concept. But the reality of it is that long-term assets are exposed to a greater amount of what's called interest rate risk than short-term bonds, okay? The other reason why short-term bonds are marginally preferred to long-term bonds, so that they're not perfect substitutes, is that longer-term assets are generally less liquid than short-term assets. The market for 3-month US Treasury bills, for instance, is enormous. It's probably measured in trillions of dollars, all right? Billions and billions of dollars worth of transactions are conducted every day. So if you want to sell off your 3-month T-bills, you can do it really quickly. They're highly liquid. Longer-term Treasury bonds, the market is also pretty deep, but just not quite as deep. They're slightly less liquid. So if you want to sell them off, you might have to take a slight haircut on the price, okay? Because of these two features, because of these two things, interest rate risk and liquidity differences, investors are going to prefer, all else equal, short-term bonds to long-term bonds. Now, with that said, it does not mean that an investor is going to be unwilling to purchase long-term bonds. They might perfectly be willing to purchase long-term bonds, but what are they going to have to be rewarded with? They're going to have to be compensated by holding these less desirable assets in the form of a higher return or a higher yield to maturity. Right, Levi, you might be willing to purchase the 2-year bond instead of 2 consecutive 1-year bonds if you're compensated for that additional interest rate risk you're taking on, or that slight reduction in liquidity, as long as you're paid a slightly higher yield than what you would get on a 1-year bond, okay? Yeah. You can, even if they do, the volatility itself, as measured by standard deviation, is risk. And if an investor is risk averse, he would rather have a, all else equal, an asset that has lower volatility and the same expected return. So in other words, the enjoyment you get out of a dollar higher extra return is not as much as the pain you experience from getting a dollar less in return. That's what risk aversion means. And so even though they might average out, it's the second moment, it's the variance or the volatility which risk averse investors want to try to mitigate as much as possible. Okay, the liquidity premium theory then holds that the interest rate on a long-term bond is just going to be the average of the interest rate investors expect on short-term bonds over the life of the long-term bond. That is what you would get under the expectations theory, plus what's called a term premium. The term premium is just this extra bit of interest that an investor is going to require in order to entice him to purchase the long-term bond as opposed to the short-term bonds. Okay, the longer the maturity of the bond, the higher the term premium has to be. Therefore, as you go out along the yield curve, you would expect interest rates on longer term bonds to be higher than interest rates on shorter term bonds because the term premium is getting bigger. That is, the yield curve should be upward sloping. Now, let me spend a few minutes talking about, Levi, do you have a question? Yeah, go ahead. I'm not going to dodge your question. I'm going to answer your question in the form of an example here, all right? And I think you'll understand this once we examine what the hell interest rate risk is, okay? Let's be really clear about what type of risk we're talking about, because this is extremely important to understanding where the term premium comes from. Interest rate risk is defined as the mismatch between an investor's financial horizon and the bond's time to maturity, all right? So Levi, you might purchase a bond that doesn't mature for 10 years, but as an investor, you might be only wanting to hold those bonds over the course of 2 or 3 years, okay? So there's always this mismatch between one's financial horizon and the actual time to maturity. Now, hopefully you guys remember from a couple of class periods ago that if a bond holder plans to sell a bond in the secondary market to an investor in the future, but it's still before the bond matures, that changes in interest rates that occur during the intervening period is going to have an effect on the bond price in secondary markets, which is going to generate either capital gains or losses, right? If interest rates start to rise, the value of your bond goes down and you experience a capital loss. If interest rates fall, the secondary market value of your bond rises and you experience a capital gain, okay? Here's what you need to understand. The longer the term of the bond, that is its term to maturity, the larger is the price change that that bond is going to experience for a given change in the interest rate. So if interest rates start to rise, let's say from 2% to 3%, your long-term bond is going to drop in price by a bigger amount than a shorter-term bond. In other words, it's going to experience greater volatility in the prices over time because of any given change in the interest rate. That's what interest rate risk is. Now, let's do an actual example to try to make this as concrete as possible. Levi, I think this will answer your question more fully. Let's consider two bonds that have face value of $1,000 and a coupon rate of 10%. So the coupon payments are $100 a year. Both bonds are selling at par, so they're selling for $1,000, which means the yield to maturity on both is just the coupon rate of 10%. The only difference in these two bonds is that one is a 3-year bond and the other is a 5-year bond. Okay, so one has a slightly longer term to maturity. Now, here's the question I want you to think about. First off, what is the yield to maturity on the bond? Well, I just told you, it's going to be 10%, right? Because that's the same as the coupon rate when the bond is selling at par value. Here's the question I want you to think about. Let's suppose that 1 year elapses and coupon rates on newly issued bonds have gone from 10 to 12%. So interest rates in the economy on comparable assets have risen by 2 percentage points. Well, we already know that the secondary market price of either of these two bonds is going to fall as a result of that. The question is, how much are they going to fall? Okay, well, let's look at the 3-year bond. We can figure out the most that an investor would be willing to pay after this 1-year period. And you can just plug it into that formula to compute the present value of a coupon bond. It would be the coupon payment of $100 times 1 minus 1 over 1 plus 0.12. That's the new yield to maturity, since interest rates have risen to 12% from 10%, raised to the second power. Why 2? Because on the 3-year bond, we've already received one of the coupon payments. So there's only 2 more to go. Divided by the interest rate of 12% plus the present value of the face value of the bond. If you calculate that, you're going to find it's $966.20, which means, Levi, if you were the bearer of this bond, you would have experienced a capital loss of $33.80. What if instead, Levi, you own the 5-year bond? In this case, the only thing that changes is the maturity. And since that occurs in the denominator of these numbers, you can see that that's going to reduce the price of the bond in the secondary market by a larger amount. Your capital loss will be $60.75. So the potential loss from a given change in future short-term interest rate is bigger if you hold longer-term security. All right? That's what's called interest rate risk, right? And so in some sense, it's not as safe to purchase the long-term bond, even though you lock into the rate. Why? Because in the future, short-term interest rates could rise. And the only way you can take advantage of that is if you sell your longer-term bond at a loss. And the longer the term of the bond, the bigger the loss you're going to experience. Longer-term securities have prices in secondary markets that are typically more volatile than short-term securities, and it's because of this interest rate risk, this mismatch between an investor's financial horizon and the actual maturity of the bond. The financial horizon here is 1 year. The maturity is 3 and 5 years. right? Yeah. It would, but you're forgetting about something. Investors don't just care about the average or expected return. They care about risk. And even though, and risk is measured as is the dispersion of possible returns. So a riskier asset, there is a chance you can earn a much higher return. That is, that you could have had a $60 capital gain instead of a capital loss if interest rates went from 10 to 8 instead of 10 to 12. But risk-averse agents don't like that additional volatility. They don't just care about expected returns, they also care about risk, right? And again, Levi, that's because if you want to think about it in terms of someone's utility function, you guys remember this from micro? As you increase your consumption or your income, utility goes up, but at a decreasing rate, right? Whereas if you decrease your consumption or income, utility falls at an increasing rate. So the enjoyment or utility, if you will, that you get out of an extra 60 bucks is not equivalent to the pain you experience by losing 60 bucks. So a risk-averse agent wants to try to mitigate risk. That doesn't mean you're going to avoid it. You're willing to take on that risk if you're compensated in the form of higher average return. That's where the term premium comes in. Okay, so the liquidity premium theory then just basically adds a term premium to our expectations equation, right? So for example, the interest rate on a 2-year bond, if we view the data through the lens of the liquidity premium theory, would be the average of the 1-year interest rate this year and expected next year, plus this sigma 2 term. That is the term premium, all right? So sigma is the term premium. 2 indicates that it's the term premium on a 2-year bond, right? So just as an example here, what if I told you that the interest rate on the 1-year bond was, let's say, what example do I have in my notes here? 2%, and that the interest rate expected on the 1-year bond next year is 4%. So the average of those two is 3%, right? Well, if the 2-year rate, Levi, is 3%, and the 1-year rates are 2% and then expected to be 4%, which one of those options would you take? Would you want to buy the 1-year bond or the 2 consecutive? Would you want to buy the 2-year bond or the 2 consecutive 1-year bond? The 2 consecutive 1-year bonds. Why? Because you're not getting any compensation for holding the longer term bond. What if interest rates next year turn out to be 5 or 6% instead of 4%? Then you lose. That's additional risk. And so to compensate you, you've got to add a term premium. So instead, if the 2-year rate was, let's say, 3.25%, maybe then you would agree to buy the 2-year bond because it's compensating you an extra 25 basis points for holding the longer term asset. More generally speaking, the interest rate on an in-year or an in-period bond would just be the average of the current 1 period and next future N-1 1-year interest rate over the life of that bond, which is in years, plus a term premium, sigma N, right? And the basic idea here is that as the length of the bond matures, the term premium gets bigger. So sigma N is bigger than sigma N-1, right? So even if investors think interest rates on short-term bonds are going to stay flat forever, the yield curve would still be upward sloping. Why? Because longer-term bonds have a term premium built into them. So when you view a moderately upward sloping yield curve through the lens of the liquidity premium theory, that probably tells you that investors think interest rates are going to stay relatively flat over time, not actually rise. So be careful about that, how you interpret the yield curve. The interpretation changes somewhat when you use the liquidity premium theory as opposed to just the pure expectations theory of the term structure. Okay, here's a practice problem. Let's have you guys and you folks that are viewing remotely work this one. I want to make sure you guys understand the basic mechanics of the liquidity premium theory. Let's suppose I give you an example yield curve. So here's the interest rate on a 1-year, 2-year, and 3-year bond today. So it's slightly upward sloping, right? 1.25% on the 1-year, the 2-year interest rate is 2%, 3-year interest rate is 2.5%. Okay. What do investors expect the interest rate on a 1-year Treasury bill to be 2 years from now? 2 years from now, if the term premium on a 2-year note is 0.2% and the term premium on a 3-year note is 0.4%. Why don't you guys take 4 or 5 minutes to work that one out and see if you can't tell me what the interest rate on a 1-year bond, on a 1-year Treasury bill is expected to be 2 years from now, given that this is what the yield curve looks like and that this is what the term premiums look like. Anybody get an answer for this one yet? Back row, yeah. Sorry? Yeah, just tell me what interest rate you got for expected to, actually, so before you calculated the 1-year rate that's expected 2 years from now, you've got to figure out what the 1-year rate is expected 1 year from now, right? What did you get for that intermediate step? 2.35%? Yeah. So according to the liquidity premium theory, what should the 2-year interest rate be equal to? The average of the 1-year rate today and the 1-year rate expected next year, plus the term premium of 0.2 percentage points, right? And so we can solve this equation then, given that the 2-year rate is 2% from the yield curve, to figure out what next year's expected 1-year rate is going to be, 2.35%. So this upward sloping yield curve then indicates that short-term interest rates are going to rise from 1.25% to 2.35%. So how do we get then what the expected 1-year rate is going to be 2 years from now? You apply the same logic, but this time to the 3-year bond rate. The 3-year bond rate is 2.5%. It should be equal to the average of the current 1-year rate, next year's expected 1-year rate, which is we found is 2.35%, and the 1-year rate expected 2 years from now, divided by 3, plus the term premium then on a 3-year bond, which in the problem is 0.4 percentage points. And 2.7%, perfect. So that upward sloping yield curve, according to the liquidity premium theory, suggests that short-term interest rates are going to rise from 1.25 to 2.35 to 2.7% over the next 3 years. So you see here how you can use the yield curve to basically make forecasts about what the expected path of future short-term interest rate is going to be. Of course, it requires that you make a guess or know what the term premium is going to be. That's easier said than done. That's not something that we observe necessarily in real time, but there are estimates of that can be used. But this is how you use the framework to try to see where the path of short-term rates are going to go in the future. Michael, do you have a question? Okay, I thought I saw you raise your hand. All right. So the term structure of interest rates then contains useful information about economic conditions. This information can be helpful in evaluating not only the present health of the economy, but also the likely future path of the economy. Information contained in the term structure of interest rates, that is particularly in the slope of the yield curve, as we've done throughout these exercises, can sometimes help us actually forecast economic conditions down the road. That's what this last section of the slides is about. If the yield curve, as viewed through the lens of the liquidity premium theory, tells us something about what investors expect interest rates to look like in the future, then that suggests we might be able to actually use the yield curve, or the slope of the yield curve in particular, to make forecasts of what economic conditions are going to be over the next months and years. Okay? Now, remember that according to the expectations hypothesis, long-term interest rates, right, the 2-year rate today, the 3-year rate today, contain information about the likely expected path of future short-term interest rates. When we viewed the yield curve in that last problem, it told us what the expected short-term rates were going to be over the next couple of years. Okay? So, given that, what do you think an inverted or downward sloping yield curve is going to tell us then about the future path of interest rates? If you observed a downward sloping or inverted yield curve, According to our understanding of this model, this suggests that investors are anticipating lower short-term interest rates in the future, right? Well, what does that tell you then about the likely stance of monetary policy moving forward? If investors think that short-term rates are going to be lower in the future, then it stands to reason that that's because monetary policy, the Federal Reserve, might be adjusting its policy to provide more accommodation in the future, a more accommodative stance of policy, right? An inverted yield curve, therefore, might suggest that monetary policy is going to be loose or easy or accommodative months and years down the road. Now, let's extend this one more. What might this then signal about the future path of broader economic conditions? So Brian, if you think by looking at the yield curve that the Fed is going to lower interest rates 6 months from now, does that give you any cause for concern? Does that signal to you that maybe the Fed knows something that you don't quite know? Sorry. Yeah, the Fed normally accommodates, right? They lower interest rates in order to try to stimulate economic growth or push prices up when the economy is lagging, right? So one way to view an inverted yield curve would be to suggest that, okay, future short-term interest rates are going to be lower. Those interest rates are going to be made lower deliberately by the Fed, and the Fed doesn't take actions willy-nilly, right? They lower interest rates in order to try to combat a recession. So perhaps the central bank here sees some dangers here on the horizon, and they would like to try to provide policy accommodation in order to mitigate that future recession. All right, that's certainly one conclusion that one could draw by analyzing or looking at the yield curve, okay? Well, let's test this, all right? Don't ever believe a theory in macroeconomics on face value. There's plenty of macroeconomic data we can look at to see whether or not this idea has any merit at all, okay? So here's the graph I want to show you. Again, this is pulled from the Fred website, okay? I've got two variables I'm looking at here. So don't get confused, but the red line shows the real GDP, shows real gross domestic product expressed as percentage growth rates. So it's the percentage change of real GDP from the previous year, all right? And that, by the way, is graphed on the left axis here. The blue line is a measure of the term spread or the yield spread. It's the difference between the 10-year Treasury rate and the 3-month Treasury bill rate. It's one measure of the term or yield spread, okay? That variable is graphed on the right axis, okay? Now, what do you guys notice here? Take a look closely at that graph. What do you see happening to real GDP growth after episodes in which the term spread starts to decline? So you can kind of see here, if you take a look at this graph, when the blue line is falling, what tends to happen to real GDP growth soon after? It also tends to decline, right? More specifically, what do you see happening to the economy when the yield curve inverts? That is, the term spread becomes negative. It's below this horizontal black line at, I don't know why I've got that at 1. That should be at, let's see, so this is 0%. So anything less than, not the black line, but the line here at 0%. What do you see happening to the economy most of the time when this measure of the term spread turns negative? So the term spread was negative in 1974, right? It was about negative 1 percentage point. That is, the 3-month rate was higher than the 10-year rate. So the yield curve was inverted. The yield curve inverted again in 1980. by a pretty significant amount, by over 2 percentage points. The yield curve inverted again in 1982, 83, again by a significant amount. The yield curve inverted again in 2001, 2000. It inverted again in 2007. It inverted again just very recently. What do you notice about that? Since 1975, every single US recession has been preceded by an inverted yield curve as measured by the difference between the 10-year rate and the 3-month rate. For every recession, it looks like, except for this 1991-92 recession. But in that case, the yield curve almost inverted. And in fact, it may have inverted if we look at different interest rates on the yield curve, maybe the 10-year minus the 2-year. I'd have to go back and look at the data. But more often than not, recessions are immediately preceded, either 6 months to a year or a year and a half prior to an inversion of the yield curve. That certainly is consistent with the story we're trying to tell, right? When the yield curve inverts, investors think short-term interest rates are going to be lower in the future. And perhaps they're going to be lower because the Federal Reserve is going to systematically lower those short-term interest rates to fight an oncoming recession. This is the sense in which the yield curve, or the slope of the yield curve, is a powerful forecasting tool. Now, let me provide just a word of caution here. It's not always going to be the case that just because you see the yield curve invert, you're necessarily going to be followed by a recession, right? Or actually, let me rephrase that. That doesn't necessarily mean that every recession is immediately preceded by an inversion of the yield curve. There was one example here since 1974 where the yield curve didn't quite invert, right? So just because you eat chocolate cake 9 times in a row doesn't mean you're going to eat it the 10th time, right? But more often than not here, we see that an inverted yield curve is definitely a signal, a pretty strong signal of future weakening economic conditions, right? That's the sense in which the yield curve has information content about the state of the economy today and also in the future. Now, let me just zero in on a particular episode so that you guys really understand the interpretation of the yield curve here. So here is the, I'm going to pick out the 2001 recession. So this so-called dot-com bubble that led to a small recession in 2001. On January 23rd, 2001, this is what the yield curve looked like, okay? And you see here that it is slightly inverted, all right? So the interest rates on 3-month Treasury bills were a little above 5%. The interest rate on the 3-year Treasury note was a bit under 5%, okay? Now, let me just ask you guys this. If you were presented with a yield curve that looked like this on the exam, or as an economic forecaster in the private sector, if this is what the yield curve looked like today, what is your forecast then of future short-term interest rates? Do you think interest rates are going to be lower in the future, or higher, or about the same? Again, I want you to view this through the lens of the liquidity premium theory of the term structure. Levi, they're going to be lower. The yield curve is slightly inverted. And once you factor in that longer-term bonds have a term premium built into them, that suggests that future short-term rates, so the 3-month rate, 6 months from now, a year from now, 2 years from now, 3 years, are probably going to be somewhat lower. And only after that point would interest rates start to kind of level out, right? The tail end of the yield curve here is moderately upward sloping, which suggests that interest rates would tend to level out over time. Okay, well, let's see if that actually played out. So fast forward to August 17th of 2001. So what, about 8 months or so later, and what has happened? What's happened to short-term interest rates compared to January of 2001? They have gone down. There's been a shift in the yield curve down. So investors were correct. They anticipated the recession, and the Fed lowered short-term interest rates by about 2 percentage points over the course of those 8 months, which back in 2001, that was considered quite a lot, all right? Now, what does the yield curve standing in August of 2001 suggest that investors think is going to happen to interest rate in the future? So it's pretty flat. Maybe it has a slight inversion over the first year, but then it has this kind of modest upward slope. How would we interpret that then? What do investors think is going to happen to short-term rates moving forward post August 17th? What would you guess here if you were an investor and you were looking at the yield curve or a private forecaster? Levi? Interest rates might go up, let's see, several years from now, but certainly over the next year. So from 1 month to 1 year maturities, interest rates are pretty flat. So according to the liquidity premium theory, perhaps investors think that short-term interest rates might fall a little bit more before stabilizing, and then over the next several years start to rise some more, which is why the 10 and the 20 and the 30-year rates are a good bit higher than the 1 month, 3 month rate. Brian? Yes, I would. That's if you had exact information on what the term premium was, you could make point forecasts like we did in that problem of what these future short-term rates were going to be, right? But in practice, we don't really know what the term premium is. We just have to kind of think about the direction that short-term rates are going to move in the future by reading kind of the slope of the yield curve. To me, this suggests that 1 and 3 month rates are going to fall over the next year because there's a slight inversion in the yield curve up to a maturity of about 6 months. But then after that, since the slope of the yield curve starts to go up at a pretty good pace, that between, let's say, a year and 5 years out, short-term interest rates are expected to rise modestly again. That's how I would interpret that. Question? It's called the liquidity premium because that's where the term that's what the term premium is attributed to, is liquidity differences. But what I would say is it's not just liquidity differences between long and short-term bonds. It's also risk, right? I don't know why it was called the liquidity premium theory, but so don't just attribute the term premium to differences in the liquidity of, let's say, 30-year bonds relative to short-term bonds. There's also a substantial difference in interest rate risk, inflation risk, other kinds of things. What does an investor care about at the end of the day? What really matters is the real return to an investment, not your nominal return. I haven't really talked too much about inflation risk, but you can adjust all of these term structure equations to be in terms of the real interest rate instead of the nominal interest rate, because the real interest rate is just basically the nominal rate minus inflation. So if we write the term structure in terms of real interest rate, that extra inflation risk then affects the real returns that you get on longer term bonds. And so that's also going to matter in terms of the term premium on longer term bonds. I just didn't present it in terms of the real interest rate. I presented it in terms of the nominal interest rate. But inflation also accounts for some of the term premium as well. But the two that I'm going to test you on that you need to know about are, one, most importantly, is interest rate risk, and the other is differences in liquidity. Well, let's see if investors were correct. So let me fast forward 1 month ahead. So now we're looking at September 13th, 2001. And what happened? Indeed, short-term interest rates fell again from, let's say, around 3.5% to around 2.75%. This is probably a bigger downward shift in the yield curve than one would infer by looking at the slope of the yield curve in August. But what do you think might be attributing to this bigger shift in the yield curve on September the 13th? You all were very young when this happened, but September 11th terrorist attacks occurred, and then immediately the Federal Reserve started lowering interest rates to try to stimulate the economy. It was a big economic shock. Financial markets kind of froze and shut down for a day. There was a lot of uncertainty. And so in order to try to help prop up the economy, the Fed provided more accommodation by lowering interest rates. Of course, that kind of thing couldn't be anticipated in August, but it did happen on September the 11th. But once again, even by September the 13th, what were investors thinking over the next couple of years? That maybe interest rates would fall a little bit more. All right, at that point, I think most people probably thought the Fed was doing all it could do to combat this, what ended up being a fairly minor recession, so that it wasn't likely that interest rates were going to drop a whole lot more, okay? But then after about a 1-year horizon, short-term interest rates should start rising again at a fairly decent clip as the economy was recovering, okay? You guys have any questions then about that? So interpreting the slope of the yield curve is an important skill, okay? And what I want you to be able to do is kind of view the yield curve through the lens of the liquidity premium theory. So just to make this clear, I'll switch over to, since we have a little bit of time left, let me do another quick example. So what if I present a yield curve that looks like this on your test? And I ask you the simple question, what do investors expect short-term interest rates to do in the future? How might you answer that? If the yield curve was perfectly flat, and then at longer maturities, it started to go up pretty quickly. What do you think what is the likely future path of short-term interest rates, if that's what the yield curve looks like today? Levi? Be careful now. I want you to view this through the liquidity premium theory of the term structure, not the pure expectations theory, right, Brian? Yes, a perfectly flat yield curve under the expectations theory means that interest rates are not likely to change. But a flat yield curve under the liquidity premium theory means that interest rates on short-term bonds are likely to go down some because we're accounting for the positive term premium, okay? However, at longer maturities, so years out, short-term interest rates are expected to rise pretty substantially, which explains why longer-term bonds have a much higher yield than the short-term bond today. What about this one over here? What if this yield curve had this funny shape to it? So it was upward sloping at short maturities, but then downward sloping at long maturities. What does that imply about the future path of short-term interest rates? Again, try to view the yield curve by using the liquidity premium theory of the term structure. Over horizons between a few months and perhaps, let's say, a year or two, what are short-term interest rates likely to do if the yield curve is upward sloping? They're likely to rise kind of moderately, right? Because remember, the longer-term bonds have a term premium built into them. So they're expected to be have higher interest rates than short-term bonds. But if there's this kind of moderate slope here, then that probably means that interest rates are going to rise just a little bit in the future. But what about this inverted portion way out here at longer maturity? What does that suggest? That suggests that investors think that short-term rates many years from now are going to be significantly lower, right? Now, this is a very odd-shaped yield curve, right? We normally don't see something like this. But if for whatever reason, maybe investors thought that some financial or economic event was very likely to occur 5 to 10 years down the road that would cause interest rates to fall substantially, then perhaps the yield curve might have this inverted slope at maturities higher than somewhere kind of in the middle of the yield curve. You guys kind of getting the point of that? So here I'm not providing you with any specific numbers, just information, general information on kind of the slope of the yield curve. But the basic idea here is to be able to try to interpret what that slope means about future short-term interest rates. We can make that interpretation because we have a specific model of the term structure that says long-term interest rates are equal to the average of current and expected future short-term interest rates plus a term premium. So if we know what short rates and long rates are today, we should be able to make an inference about what short rates are going to be in the future by utilizing that equation or relationship in the term structure. Okay. You guys now know everything I know about monetary economics. That's it. There's no more material. So what are we going to do here? So after Thanksgiving, there's no class, right? So what I'm going to do is I'm going to make your fourth lab assignment available to you on Blackboard on the Wednesday after Thanksgiving. I don't remember what particular, maybe December the 2nd, I think is what it is. You guys can take, let's say, a couple hours or whatever to do it, or it doesn't really matter to me if you want to take a little bit longer than that. And again, if you want to work in groups, you're welcome to do that. Just submit your answers to me through email, okay? And I'll have the TA grade it like the other one. And then your exam, your final exam is going to be on maybe the 9th of December, I think. And that's going to be from 7 o'clock to 9:30. So what we're going to have to do for that is basically have everybody in the class, then all 40 or so of you, log into Zoom between those hours, and you'll just take the test remotely and just submit the test electronically too, okay? Depending on how things go for me after Thanksgiving, I might be able to hold a remote review session the Monday after Thanksgiving, if that's something that students are in demand for. But there's no new material after today. So that means I would come in here on Monday night at the regular time and work some practice problems, and you guys can view it through Zoom. But if there doesn't seem to be a big interest in that, then I don't need to do that. But the lab will then be on Wednesday, okay? You guys have any last questions about the material? We good? Okay, good luck with all your other classes and your final exams.